You ever get that feeling that the stock market is just moving on its own? Like there's some hidden force pulling all the strings behind the curtain? Well, what if I told you there's a massive $20 trillion trade, one that basically funded our world for 30 years, and it's suddenly and violently starting to unwind? Okay, let's get into it.
I mean, if you've been watching the markets at all, you've seen it. The wild swings, the sudden drops, that general feeling of chaos. You see a stock like Nvidia shoot up 5%, then just tank 3% in the same day. And you have to ask yourself, what is going on? Well, the answer is way bigger, and it's been building for a lot longer than you probably think. At the very heart of this story is this number, $20 trillion. I mean, just let that sink in. It's an amount of money that's almost impossible to even imagine. We're talking about an arbitrage trade so huge, it's been called the biggest in human history. And it has been quietly propping up global markets for an entire generation.
And now, that trade is completely breaking down. The very foundation of cheap money that fueled this global boom, it's cracking. And you've got experts out there warning that its collapse could set off a financial crisis that makes 2008 look like a walk in the park.
So, what is this mysterious financial monster? Well, it's called the Japanese yen carry trade. And honestly, the best way to wrap your head around it is to just think of it as the world's 0% mortgage, a deal that always seemed just a little too good to be true. And, well, maybe it was.
Okay, the official definition, it sounds a little complicated, I know, but the idea is actually brilliant in its simplicity. You borrow money where it's practically free, in this case, Japanese yen, and then you go invest it somewhere you can get a much better return, and you just pocket the difference.
Let's just walk through how this profit machine actually ran. For 30 years, ever since Japan's economy hit a wall back in the 90s, the Bank of Japan kept its interest rates pinned near zero. So step one, a hedge fund borrows, say, 1 billion yen for basically nothing. Step 2, they immediately sell that yen and buy US dollars. Step 3, they take those dollars and buy something that pays them well, like a US Treasury bond that yields 5%. And step 4, they're earning that 5% while paying almost 0% on their loan. It was a no-brainer. It looked like a completely risk-free trade.
But here's the thing. This wasn't just some niche strategy for a couple of clever investors. Oh no, this thing went global. This trade literally became a foundational pillar of the entire modern financial world. It was like a silent river of capital that just flowed into pretty much every single market on Earth.
So where did all this cheap money actually go? A huge chunk of it came directly into the US markets. It was a silent, constant buyer of stocks, and it was a massive financer of US government debt. In fact, Japan is the single largest foreign holder of US treasuries. And here's the part that really matters to you. This isn't some abstract thing happening far away. This money is in your 401k, it's in your retirement funds. We are all connected to this trade, whether we knew it or not.
Now, what's so wild about this chart is that it shows you why this was all possible for so long. Just look at Japan's debt to GDP ratio. It's a staggering 255%. To keep their own economy from sinking with that much debt, they were forced to keep interest rates at zero. And in doing so, they basically created the world's cheapest currency to borrow. They became the bank for the rest of the world.
The entire system, this $20 trillion bet, was all built on one single critical assumption. The Japanese interest rates would stay at zero forever. But as one analyst perfectly put it, that assumption died yesterday.
So what happened? Why is a trade that worked like a charm for 3 decades suddenly just falling apart? Well, the simple answer is that the economic conditions in Japan that created this perfect storm in the first place have completely flipped on their head.
And this slide lays it out perfectly. In the past, you had near zero interest rates. Now Japan's rates are finally rising off the floor. For years, Japan was fighting deflation, falling prices. Now, core inflation is surging, forcing the Bank of Japan to finally do something. And the yen, which was always reliably cheap and weak, is now getting stronger as all those investors rush to buy it back. The free money machine is officially broken.
And look, when a $20 trillion trade reverses, it doesn't just quietly stop, it unwinds. And that unwinding sets off this incredibly dangerous domino effect that just ripples across every single interconnected market in the world. Here's exactly how that chain reaction gets going. Step 1. All the investors who borrowed all that yen now have to pay it back, so they all rush to buy yen at the same time. Step 2. All that sudden demand makes the yen get stronger and way more expensive. So step 3. Their loan, which is in yen, now costs them a ton more US dollars to pay back. Suddenly, they're losing a fortune. So what choice do they have? Step 4, they are forced to sell whatever they own, stocks, bonds, you name it, just to get the cash to cover that now expensive yen loan.
This forced selling of trillions of dollars in assets leads to two pretty catastrophic outcomes. First, you get the risk of a flash crash. When everyone is a forced seller and there are no buyers, prices just collapse. We've already seen a little preview of this with those violent swings in tech stocks. And second, you get a massive liquidity drain. It's like a giant vacuum cleaner sucking trillions of dollars out of global markets and funneling it all back into Japan to pay off these loans.
And where is all this selling pressure most likely to hit? You guessed it, right where all that borrowed money went in the first place. High-flying U.S. tech stocks, U.S. Treasury bonds, emerging market debt, and other risky assets. The very things that shot to the moon on the flood of cheap money are now the most vulnerable as that tide goes out.
And this all leads us to one final and honestly a deeply unsettling question about the future of the market as we've known it.
So here's the real kicker. All this forced selling of U.S. Treasury bonds pushes their prices down, and when bond prices go down, their yields, the interest they pay you, go up. So think about it, if you can suddenly get a guaranteed 6% or even 7% return from a super safe U.S. government bond, why on earth would you take the risk of investing in the stock market? The simple answer is you wouldn't, and that mass exodus out of stocks, well, that's the nightmare scenario.
Which leaves us with this one last thought. For 3 decades, our entire global economy was built on a foundation of incredibly cheap Japanese debt. It fueled our bull markets, it financed our governments, it pumped up our retirement accounts. So what happens when that foundation suddenly and completely just vanishes?